Welcome to the Joshua Ngoma podcast for spiritual inspiration and Africa's strategy positioning in global politics.
Hi there. Africa's strategic focus on common sense policy reform, infrastructure development, and manufacturing. Before COVID-19 pandemic, economic projections expected Africa to create 54 million new jobs by 2020, but 120 million Africans would enter the labor force during that same period. This shortfall is an addition to the tens of millions who are currently unemployed or underemployed. They have a job but do not make enough money to live above the poverty datum line. Africa's main challenge moving forward is that of chronic unemployment. Independent of other factors, high levels of unemployment remains the single most urgent threat to derail Africa's fortunes and potentially threatens the whole continent. This is a grim outlook, and Africa's new leadership should grapple with this daunting reality. If we choose to ignore this catastrophic problem of unemployment, Africa will be a drag on global economic growth and resources for many generations to come. Even with the remarkable strong economic growth Africa has enjoyed over the past 2 decades or so, job creation, however, remains much slower than the young people entering the job market. Africa requires a comprehensive and coordinated approach to tackle the unemployment crisis. Some of Africa's leading economists and emerging entrepreneurs have suggested an economic intervention similar and equivalent to in magnitude to that of America's Marshall Plan in Europe after World War II. The Marshall Plan was an aid package from the United States of America worth $13 billion given to Western European nations between 1948 and 1951 to rebuild their economies after World War II. The effort focused on building infrastructure, modernizing the business sector, and improving trade. After 4 years, Europe's post-war economic output surpassed its pre-war capacity. Africa should do the same. Africa's Pan-African economic and business thinkers have suggested that the public, private, and developmental sectors should come together to create new jobs and social wealth. The African private sector has the power to transform the continent by creating value within Africa through long-term investments. The private sector, in conjunction with philanthropic and public sectors, can solve Africa's development challenges more effectively and with greater sustainability. All economic stakeholders in Africa, namely government leaders, entrepreneurs, politicians, philanthropic foundations, developmental organizations such as the World Bank and the International Finance Corporation, should come together to solve Africa's unemployment challenge and transform the continent into a global economic engine. It is also a call to action for Africans to take primary responsibility for our own development and for non-Africans to evolve their thinking about how best to channel their efforts and investments in the region. Africa's new vision for economic success, among others, is dependent on strategic focus in developing 3 interdependent sectors, namely common sense policy reforms, investment in infrastructure, and development in Africa's manufacturing and processing industries. Administrative and bureaucratic reforms will make it easier to do and set up businesses in Africa. Consequently, attracting more investment, increased entrepreneurship, and ultimately create more jobs. Governments need common sense policies that help reduce administrative and operational costs for investors and businesses. Both local and foreign investors should find it easier to process licensing, permits, and visas. Reduced import duties and tariffs, especially in equipment, machinery, and technology, have a direct impact on economic growth. Economic and job growth requires a predictable, safe, and reliable policy environment. Strong civil and legal institutions, corporate financial transparency, accountability, democratically elected politicians, open, modern, and transparent markets are all essential elements in attracting capacity investments. For example, positive government policies in Kenya paid off handsome dividends with the Microsoft Corporation. The Microsoft Corporation teams worked hand in hand with the Kenyan government's Ministry of Information and Indigo Telecom to deliver low-cost solar-powered broadband access using cutting-edge TV white space technology. This project depended on the goodwill of the Kenyan government, freeing up unused white space in the TV and radio broadcast spectrum. TV white spaces are the unusual portions of wireless spectrum in the frequency bands generally used for television. They are particularly well suited for delivering low-cost broadband access to rural and other unserved communities, making the technology best suited for Africa. According to Microsoft, radio signals in the TV bands travel over longer distances and penetrate more obstacles than other types of radio signals and require fewer base stations to provide for an ever-present coverage. Microsoft intends to use this pilot and other similar projects to encourage African governments to make the needed legal and regulatory challenges or changes that would allow this type of technology to be deployed across the whole African continent. Similarly, financial services reforms across several African nations like Nigeria have seen the growth of the financial sector. The government's privatization program has attracted billions of dollars of private investment to develop Nigeria's power infrastructure. African governments and the private sector must also commit to strong and transparent institutions to help boost confidence in Africa's business climate. Botswana, Rwanda, and Liberia have made huge progress in this regard, but war and civil unrest keep eluding the progress of some of African countries. Infrastructure development. Another cardinal area in Africa's development program must be infrastructure development in transportation and energy, without which development is a non-starter. Outdated and non-existent infrastructure remains one of the biggest challenges for investors wanting to invest in sub-Saharan Africa. In spite of these challenges, though, sub-Saharan Africa has an attractive consumer spending power, estimated at 1.2 trillion United States dollars in 2021, supported by a rising population and relative political stability. According to the African Development Bank, the region's infrastructure backlog needs $130 to $170 billion a year for infrastructure development. The infrastructure financing gap in Africa is about $100 billion. African governments and international partners such as China and traditionally the primary investors in infrastructure development. Due to financial constraints, there is a growing need to explore public-private partnerships, PPPs, Public-private partnerships are crucial in closing the financial gap for infrastructure development in Africa through collaboration between governments and the private sector. Roads, electricity, and sanitation have the greatest need for investment. 53% or 600 million people in sub-Saharan Africa lack access to electricity, and hundreds of millions more have limited access. Access to affordable electricity is an imperative. The estimated economic losses on the South African economy due to load shedding was about 560 billion rands in 2022, with even greater projected losses for the future. A consistent electricity supply will unlock the continent's growth by reducing operational costs and enabling business growth, including homegrown local businesses that are the engine of economic and employment growth. New technologies in clean energy like solar and wind are the future for Africa's energy mix, including nuclear and hydro energy. Africa must first connect with each other and then to the rest of the global trading partners. It is many times easier to move products abroad than within the continent. Projects like the toll road between Entebbe and Kampala and the Kenya-Tanzania highways facilitate great trade in agriculture and manufactured goods within Africa. About 47% of Nigerian farmers have no access to storage facilities. If these high levels of wastage were reined in, the continent as a whole would achieve considerable levels of food security. Many multinationals and African conglomerates are investing heavily in Africa in spite of infrastructure challenges. Africa's stock markets are delivering decent returns, while mutual funds and private equity capital are increasingly flowing into African markets. Multinationals like Walmart, Barclays, Microsoft Corporation, and Diageo are expanding their operations, and in some cases, they are building their own infrastructure. Multinationals are coming up with clever ways of doing business by getting around the continent's dilapidated roads, inconsistent power supply, and inefficient ports. They have taken up the responsibility of taking the products directly to the markets themselves. For example, a consortium consisting of Trafigura, Motor Angel, and Vectoras have an exclusive concession for the Lobito Corridor project for 30 years, with a possible extension of another 20 years. Trafigura and Motor Angel both own 49% in the consortium, and governments of Angola, Zambia, and the Democratic Republic of Congo have zero stake in this huge project worth 2.5 billion United States dollars. The Lobito Corridor offers an alternative and strategic route for Zambia and DRC to exports markets in the shortest route linking key mining areas in the two countries to the sea. The current leader in the world's transition to electric vehicle technologies is China, and is ahead in the mining and processing of the required minerals for the green energy revolution, such as of copper, cobalt, lithium, and graphite. The Lobito Corridor is the West's answer in countering China's dominance in the critical minerals trade required for the green energy revolution. Manufacturing. Africa needs to invest in building its own manufacturing and processing industries. Currently, Africa has no capacity on the most part to add value to most of its natural resources because of a lack of refining industries. Instead, it trades in goods already processed mainly from overseas. Raw materials such as copper, oil, cocoa, and gold are shipped overseas, where they are processed into high-margin products and are often re-imported to Africa, costing the continent potential jobs, and export earnings in hard currency. Nigeria ranks as Africa's largest producer of oil and the 60th largest oil producing country in the world. Nigeria exports raw crude oil and then imports expensive gasoline. The 19 billion United States newly built first privately owned Africa's biggest oil refinery is a game changer for Nigeria and the region. The Aliko Dangote oil refinery has the capacity to produce 650,000 barrels per day. At full production capacity, the plant is expected to meet 100% of Nigeria's demand for gasoline, diesel, kerosene, and aviation fuel, jet fuel. Africa's inability to process finished goods from its raw natural resources at home and then trade them within Africa has drastically limited the continent's growth potential and thus its ability to create tangible wealth within its domestic economies. We now know that Africa will not rise to economic prominence when its major exports are raw materials in their most basic form until we can add value by turning our raw natural resources into finished goods and services through industrial production. Africa will not change its fortunes. We export raw materials on the cheap and buy back finished goods. For centuries now, Africa has been exploited for cheap natural and human resources, which are clearly indispensable to the viability, sustainability, and growth of the global economy. Bridgestone Firestone's main source of rubber for its multi-million tire business is in Liberia, West Africa, for over 80 years. Although Liberia has supplied the rubber raw material still harvested in primitive conditions, it has no single manufacturing base to convert the raw rubber into finished products like tires for exports. 70% of all cocoa bean production is in West Africa, shared between Ghana, Ivory Coast, Nigeria, and Cameroon. Although the cocoa bean is predominantly grown in West Africa, it is mostly processed, manufactured into chocolate products, and consumed by industrialized countries. African countries are not only the major producers of cocoa, but they are also major exporters of the raw bean. In Ghana, 70% of the chocolate is imported in the country's market, while only 30% is produced locally. In the next 2 decades, the value of African-made chocolate consumption will increase threefold, amounting to income of $23 billion. It is noteworthy that while Brazil and Malaysia are also main producers of cocoa beans, they are not necessarily large exporters due to a considerable huge size of their processing industry, which absorbs the beans within local production. In the 1950s and 1960s, many governments of commodity producing and consumer countries became actively involved in managing commodity markets through international agreements. This led to the signing of international commodity agreements by both producing and consumer countries, such as the Tin Agreement of 1954, the International Sugar Agreement of 1954, the Coffee Agreement of 1962, the Cocoa Agreement of 1972, and the Natural Rubber Agreement of 1980. These agreements between leading producing and consumer nations were meant to stabilize commodity prices, ensuring adequate and a secure supply to consumers and promote economic development in the producer nations. In addition, some producer nations formed organizations of their own, such as the Organization of Petroleum Exporting Countries, OPEC. Although commodity producing countries in Africa were not left out of these agreements, their membership in them did not help in reducing the volatility or the decline in commodity prices. The dominant feature of international commodity markets since 1980 has been an underpricing of a number of important commodity exports of developing countries, particularly in Africa. Establishing Africa's own leading financial institutions. In December of 2007, Latin America and American countries, including Argentina, Venezuela, Chile, Paraguay, Bolivia, Uruguay, and Colombia, launched a new bank called the Bank of the South. The intent of the new bank is to offer an alternative and a break from what its founders termed Washington-dominated International Monetary Fund, IMF, the World Bank, and the Inter-American Development Bank, which focuses entirely on Latin America. All member countries contributed to a startup capital of $7 billion and governed on a one country, one vote basis. The president of Brazil, Lula da Silva, said about the new bank that developing nations must create their own mechanisms of finance instead of suffering under those of the IMF and the World Bank, which are institutions of rich nations. It is time to wake up. In a similar fashion, Africa is emulating South America. In 2014, the African Union AU Summit approved the creation of an African Monetary Fund, AMF, to be based in Yaoundé, Cameroon. Progress to set it up has stalled. The treaty was signed but requires ratification from 11 out of 15 member states. The fund will have an initial capital of $23 billion to promote economic development in Africa and to ease the conversion of currencies across Africa. It will also promote monetary cooperation to achieve economic integration and to speed up economic development within Africa and help tackle macroeconomic matters on the continent. The fund's purpose is to correct balance of payment positions that exert a negative burden on currency stability, mainly caused by low export of commodities and high import volumes. The fund is also expected to ensure exchange rate stability, apart from creating a proper landing system in Africa to correct the balance of payment imbalances within the continent. Apart from establishing African financial markets, the fund will also design formulae to lower the debt burden and other debt management policies in Africa. Of the 500,000 shares to be issued by the fund, South Africa is expected to get the highest allocation of 8.5%, translated into nearly $1 billion, followed by Nigeria's 7.9%, translated into 899 million in capital contributions. Egypt is expected to subscribe 6.1% of the shares, a contribution of $690 million, and Algeria, which is to be allocated 4.5% of the share, will contribute $520 million. Ethiopia will be given a subscription rate of 3.4%, valued at $380 million. The Democratic Republic of Congo, DRC, will get 2.7% of the shares with 316 million contributions, and followed by Kenya's 2.5%, valued at 283% contribution. South Sudan will just get 0.5% shares, a contribution of $64 million. Cape Verde and Comoros will get 120 million and 110 million respectively. In 2010, another group of 5 emerging world economic powers, also called the BRICS, namely Brazil, Russia, India, China, and South Africa, met in South Africa for a summit at which they also planned to announce the creation of a new development bank. This move was seen as a direct challenge to the dominance of the World Bank and the International Monetary Fund. The BRICS also agreed to create the bank to focus on infrastructure and development in emerging markets. The countries also intended to pool their foreign reserves together as a safeguard against a currency crisis. This was part of a growing effort by emerging economic powers to build institutions and opportunities that are alternatives to the West. Thank you for watching and listening. Bye.
Thank you for listening to the Joshua Ngoma podcast. Bye for now until next time.